I'm Paulo Cunha. I'm the Associate Director of Operations at the Vale Columbia Center. I want to thank you all for coming tonight. We have an esteemed panel here with us to discuss success in Africa, CEOs, investment, and development on a fast-rising continent. Let me just start off by introducing the three centers that are organizing this event tonight. The Vale Center is the leading forum on issues related to foreign direct investment, paying special attention to the impact of such investment on sustainable development. Our objectives at the VCC are to analyze important topical policy-oriented issues related to foreign direct investment, develop and disseminate practical approaches and solutions, and provide students with a challenging learning environment. We are co-sponsored tonight by the Chazen Institute of International Business. The Chazen Institute supports, sponsors, and promotes thought leadership and frontier research at the business school on issues of significance to the global economy and business. It's the focal point for international business programs at the business school. And finally, the Lang Center on Entrepreneurship, its role, its mission is to instill entrepreneurial thinking in all Columbia Business School students and to create a community of business practitioners with a lifelong commitment to achieving social and economic progress through entrepreneurship. So we want to thank the three centers for co-organizing this event tonight. So as I mentioned, we have an esteemed panel. Let me first mention our moderator and one of our panelists, Professor Paul Tierney, Jr., to my left. Professor Tierney has been a highly respected global investment professional for over 30 years. His experience and relationships have helped Aperture's portfolio companies in a variety of valuable ways. Prior to Aperture, Paul was a co-founding principal of Gallus, Tierney, and Oliver, the general partner for Constant Partners, which was a $1 billion active value investment partnership. He's also currently the chairman of the board at TechnoServe, a nonprofit organization dedicated to promoting entrepreneurship in Latin America and Africa. And as I mentioned, he's an adjunct professor at Columbia Business School teaching courses on private equity. Our second panelist to my far right is Antonio M.A. Pedro. Antonio is a mineral exploration geologist with 30 years of experience in mineral resources development at the national, sub-regional, and continental levels. He's currently the director of the United Nations Economic Commission for Africa's sub-regional office for Eastern Africa in Rwanda. Previously, he was the chief of infrastructure and natural resources development at ECA headquarters in Ethiopia. The man of the hour is our author and chief panelist, Jonathan Berman. Jonathan is a senior advisor to Dahlberg, a strategic advisory firm focused on frontier markets with 10 offices worldwide. Jonathan previously served as a partner and director of Dahlberg's corporate practice. He's also a senior fellow at the Vale Center here at the law school. Most recently, he's obviously the author of Success in Africa, CEO Insights from a Rising Continent, which we'll discuss tonight. Obviously, it features the views of global and African CEOs on the unique dynamics of fast growth markets. I'll let him talk some more, obviously, about the book. I do want to just quickly give some housekeeping notes. We'd love for you to tweet, if possible, the tweet handle is Success in Africa. Jonathan's Twitter handle is at Jonathan_Berman if you want to find out more about his work. So without further ado, let me introduce Jonathan Berman to give you a quick introduction to his book. Jonathan.
Thanks, Paul. The book has only been out for about a week, and so I still occasionally glance at notes when I'm talking. Let me take a look at it. And while I do, first of all, let me say it's an honor to be here. I'm recently affiliated with the Vale Center. I got to know it through its director, Lisa Sachs, with whom I interacted on something called the Natural Resource Charter, and just found found her dynamic and the whole prospect of the center's agenda to be highly dynamic. I encourage you to take a look at it at the Vale Center if you don't know them now. It's also an honor to be in these halls. I went to high school not far from here, and was often up in these halls. Louis Henkin, who taught here for many years, was a formidable part of my childhood, and I associate it with great learning and distinction. So it's nice to be here. That's as good a place to start as any with my upbringing. You wouldn't expect that a guy from the Bronx who spent a little time in Manhattan and very little time overseas growing up would be the right person to write a book about success in Africa. I'm not myself an African, nor am I at the current time a CEO. But I thought it might merit a little thought about how I came to write that book, and then tell you a little bit about the people in it who are really the heart of the book. So I wasn't originally an Africa specialist. I was an Asia specialist. I learned a fair bit of Chinese in college, a little more than I have now, and spent the next 10 years sort of bopping around Greater China doing management and strategy consulting for companies there. But while I was there, I got to get a sense of what fast growth economies look like. What does an explosive economy, transformative political economy look like and feel like? And those of you who have lived in such economies know that it has a certain feel, it has a certain hum to it. And it was through the relationships that I made there, that with some companies that were there, that I eventually came to Africa about 10 years ago. And you really don't have to be in a place like Lagos or Nairobi very long before you know you are in such an environment again. If you're familiar with it, you can feel it. One you'd only look at the road in from Lagos, which you get from Lagos Airport, where you get a long time to look at the road to know that you're in a place that's quite explosive and dynamic. And in fact, I'm far from the only sort of Asia hand that has found, as they've looked for sort of the next exciting frontier market, to have found my way there. One of the featured CEOs in the book, Tom Gibeon of Emerging Capital Partners, cut his teeth in Asia. The head of Delta for Africa cut his teeth in Asia. Unilever, GE as well. J. Ireland, GE Africa is in the book, also long time China hand. So there are a lot of people who move from one to the other. Not that all the lessons are translatable. I think that's mostly not true, but that the appetite for where growth is happening, the appetite for the frontier, might well drive you to a place like Africa. But what I found working after about the first 5 years of working in Africa is that I was living in kind of a parallel world. Those who are there and those who are working there with them can feel it all around them. It's been understood within Africa that there's growth, that something special is happening on the continent. There's been explosive growth. But when I would land in Geneva or make a transfer at Frankfurt and get on the next plane to come home, almost no one knew that story. Most of the people I met, even very, very well-informed people in international management, investment management, as well as international economic policy, so we're still thinking of Africa as a place basically of happy animals and miserable people, sort of a Lion King kind of universe. And we knew better. So that dislocation troubled me. At the same time, I was working with some of the most dynamic CEOs in the world, in Africa's emerging CEOs. And I had the benefit of working with terrific business leaders in Asia and in the States, a little bit in Europe, and nowhere had I found kind of a vision and a drive and sort of a charisma that marked a lot of the CEOs that I was meeting in Africa. I mean, to this day, I think that some of the men and women in the book are really, the Rockefellers, the Pierpont Morgans, the Andrew Carnegies of their day. They're not here in the States. That was in their era here. They are in Africa. And that became the vehicle by which I decided I would tell that story, the way in which I would change the narrative of Africa amongst all the people I was meeting on that second leg of the journey out, those people who didn't know what was happening. They didn't know what was happening, not because the facts weren't in evidence. There's plenty of data out there, really good data, from peer organizations like McKinsey to the international financial institutions are well documenting Africa's rise. What is lacking is a narrative to overcome the strong narrative that precedes it in our minds about Africa. I mean, I think our entertainment industry and our news industry, to the extent those are even distinct, have a make a lot of profit off of displaying Africa in a way that we are very comfortable with. And so to dispel that, my goal was to write this book that is, first of all, about Africa as a business opportunity. It's a business book for a business audience. But then also to populate that book with a narrative and characters who are as compelling as those prior narratives and characters. And I think I've done that. The best way to do it is, the best way to share it with you is just to share 3 quick vignettes, and then I'll pass it off to Paul to offer some comments, and to Pedro as well. So, who's in success in Africa? Because that's what matters. I'll start with someone who some of you may know, James Mwangi of Equity Bank. So James, Equity Bank is one of the most profitable banks in all of Africa, and James is the Forbes Africa Businessman of the Year. But he started life poor, really poor. He was, as a child, hauling coal to his neighbors, and then he moved upscale and began hauling fruit to his neighbors in rural Kenya. But what he discovered along the path was that those neighbors had money to pay for his goods, for other goods. They had a certain amount of discretionary income. They just weren't putting it into banks because they didn't trust the bank was too far from them, and as he put it, their lives are unplanned. They need a certain immediacy to their money. And so he brought the bank to them. First, literally, on trucks, he brought mobile banks out to the rural population. And then, more broadly, in both rural areas and in slums, set up agency banking to replace branch banking. Agency banking is basically finding a shopkeeper, finding a provider of agricultural inputs, finding somebody who people are going to already and basically setting up a bank in their shop. And Equity Bank has done more transactions in the last 2 years with agency banking than it did in the past 20 years with branch banking. That's the kind of insight that you get from living in the space. And Bob Rubin, who wrote the foreword to the book, cited it as sort of one of the more eye-opening insights that he found from listening to and reading the comments of people like James Mwangi. Another sort of African titan, if I could, is in the book that is less well known here, for reasons that sort of mystify me, is Fatuma Naleko. Fatuma Naleko is the longtime CEO and now chairman of MTN, the largest mobile network in Africa, the 6th or 7th largest in the world, and really sort of the model for many of the other younger CEOs in the book of what a Pan-African company can look like. Fatuma had the start of his career in South Africa. He was born in Swaziland, but really came of age in South Africa, and describes with great precision and a little bit of pain the story of his early career in South Africa, in which his world was getting progressively smaller as sort of the noose around apartheid tightened. And it was only when he left Africa for college and grad school here in the States, at Ohio State and then at Atlanta University for his MBA, that he found other Africans, that he was able to interact with other Africans in an environment that didn't have the pall of apartheid over it. And indeed, at Atlanta University, a traditional black university here, discovered and explored possibilities for Africa that were beyond those of the traditional Western perception of Africa as a place of charity, essentially. And he brought those ideas back to Africa, and there's, by his lights, fundamental to the vision he built for MTN of first a Pan-African and now truly a globally competitive telecommunications firm. Of course, you don't have to be African to succeed in Africa, and I think that there are lessons in the book for Western, and particularly for American companies as well. CEOs like Jeff Immelt of GE have long experience in fast growth markets and are doing well in Africa as well. Jeff speaks specifically of sort of the role of the CEO in helping his organization become comfortable with uncertainty in those markets. He tells a story in which it comes from a trip he made last year to Angola, in which GE had long been pursuing a joint venture that had been held up for over a year because they couldn't get to certainty over the land tenure. There were issues. I mean, this is a common issue, not just in commerce, but across African development, right? Land tenure problems exist both for the smallest farmer as well as for the largest corporate entity. And this issue had held up GE's joint venture in Angola for over a year, as it would almost anywhere. They wouldn't be able to proceed without specificity on land tenure. Jeff met with the team and advised them to proceed without that certainty. Because as he said, if you wait for everything to be certain, you'll never go. He had been in enough frontier markets to have seen this repeatedly, that he had both a comfort that they could achieve their returns with that level of risk, but also to convey to his management that he wanted them to be moving forward with that level of uncertainty or risk, because the returns were perceived as high enough to warrant it. That is not, I would argue that's not the framework in which a lot of American companies find themselves today. And I think it's a lesson that could be adopted here. So, with those three quick snapshots in mind, I sort of think about three takeaways I would have people take from the book. One is that Africa is a place of extraordinary opportunity, extraordinary difficulty. The barriers to entry are high. As one CEO, friend of Paul's and mine, Bharat Thakur, says, the grass is greener here, but it's not for everybody. But the grass can be pretty green. The second is that opportunity is really being built by Africans more than anybody else. I think we have a tendency to think that Africa's growth is a function of Western aid, or Chinese demand, or God's grace in putting the ore in a certain place. All of those are actually, I think, important inputs to the story. They're not the core of the story. The core of the story is governance, connectivity, education, things that Africans have built for themselves, and forces from which some of the men that I just mentioned are products of. And then finally, that for international firms, really for American firms operating in Africa, there is also great opportunity, not just commercial opportunity, but an opportunity, and this I think applies especially to people who are in business school today, an opportunity to achieve, both significant wealth for yourselves and for shareholders, while also delivering enormous social wealth and social capital. There are few places in the world that need as much as Africa, and that are going to have the means to pay for it. And so, while there's always going to be a certain amount of wealth made from serving elites, or from delivering luxury goods, serving international clientele, or from rent-seeking and corruption, which I think will persist, in some measure in Africa, none of those is the core of the opportunity in Africa. The largest share of economic opportunity across the continent is in developing productive products for millions of people who are rising out of poverty. That's a pretty exciting place to go do business. So with that, I'll pause and turn it over to my colleagues, Paul and Pedro. Okay.
Please. First of all, let me congratulate Jonathan for a very, very important book. It's a book that is consistent with the current narrative on the continent. We are now, I don't know anything about investment. I'm not a CEO, but I understand a little bit of what's happening on the continent. After all, I'm African. So it's a more mature continent now. It is a continent that believes in itself, in the power of its indigenous ideas, and that is being translated through successful stories, as Jonathan shared with us, but also through all sorts of frameworks that the continent is developing with a view to ensuring that it extricates itself from poverty. And I would like to pick some of the foundations on which this window of opportunity is based. And this is in Jonathan's book. First, I mean, there is a demographic dividend. I mean, after all, by 2050, Africa will have 2 billion people. So this is a market that offers opportunities for any investor. The second dimension to consider is that is a rising middle class. We're talking about 600 million people that are entering into the middle class sort of category. And urbanization also is moving fast. 60% of Africans will be urbanized in a couple of 10 years or so. So these are significant numbers that are driving some of the narrative on Africa is rising. So this is important. And also, as indicated in his book, the governance score on the continent is improving. And that, of course, contributes to reducing the risk profile of the continent. Whilst in the past, you had a succession of coups and all sorts of problems in the continent. Today, democracy is taking, is becoming part of almost in every country today. There are democratic processes. And the macroeconomic fundamentals are also very sound, and that gives confidence to any investor. So those are issues that I guess one has to retain when you're talking about the continent. There are just a quick reference to some of the key frameworks that are informing discussions on the continent today. At the level of the African Union Commission, they are now in the process of developing what they call the Vision 2063. This is essentially Africa 50 years from now. Looking at what are the key aspects that would would ensure that the continent can play a rightful role in the new economic order. The Vision 2063 is founded first in harnessing Africa's natural resources. It's a comparative advantage that can catapult the continent towards a greater transformation. Addresses its infrastructure deficits. They are a serious problem. They increase transaction costs to business. Educating its population in order to increase Africa's competitiveness. And a lot of it also is driven towards making Africa a more unified space. As you know, we have 54 countries on the continent. Some of them are too small to be competitive. So through processes like regional integration and harmonization of laws, policies and regulations to facilitate factor flows, you are creating a larger market. So those are issues that are now being discussed in the continent, which is just that are consistent with what is written in this very, very important book. In addition to that, the continent is now, as everybody else, looking at the post-2015 development agenda. And in the case of Africa, the continent is talking about African development goals. So it's beyond the sustainable development goals that the UN is proposing. It's really contextualizing the narrative to Africa's own situation. So this is important. You have civil society organizations that are becoming more and more involved in policy formulation. So domestic accountability is strengthened through those processes, and this is important as a pressure group towards having governments that are more accountable to their citizens. So let me perhaps stop here and conclude by once again congratulating Jonathan for this important book, which is, as I said, is consistent with the current narrative, with the belief on the continent that it can indeed play a much important role in global economics. And then with Q&A, I guess I can address other issues which are important in this discussion. Thank you, Jonathan.
Thank you. I'm kind of here in several capacities. I've for many years been active in an organization called TechnoServe as chairman, and we were founded 42 years ago in Ghana. And for most of the existence of TechnoServe, the different members of the staff have always thought it was a good idea to also provide capital to people in addition to technical assistance, which I've always been reluctant to do because of the conflicts of interest that it could present to clients of ours that we're trying to help primarily in the rural sectors. But I've often said to our guys in the field that if you bring us a good investment opportunity, we'd find a way of financing it. And it wasn't until 4 or 5 years ago that we started seeing a number of things that we wanted to finance, and as recently as 3 years ago on the things that we wanted to commit capital to individuals, but not TechnoServe as an institution, we were turned down by the entrepreneur. In other words, the entrepreneur had not only developed better opportunities, but he'd also seen more and more capital sources that had come into his market. Some of them rather irregular capital sources that were doing things at less than market rates of return, but a lot of, nevertheless, capital that was now available to the grassroots businesses in the societies of Africa. So I congratulate Jonathan also on a nice book and a nice job, and I agree with 98% of what he said in this book. But I'd like to try to just turn to one of the chapters that he's written and maybe see if we could go a little bit in a deeper direction or a different direction. In the beginning of chapter 5, Jonathan, you laid out a few characteristics that you thought were those that were common to the African leaders that had succeeded in Africa. You said they embrace uncertainty, they get their hands dirty, they build what they need, they're resilient, and they tailor their enterprises to local culture. I would agree with all of that, but I also would say that those are characteristics of successful entrepreneurs that I know in the United States and in Asia and many parts of the world. So in his book, of course, he goes into a fuller explanation of these, but I was trying to think in my own mind as an investor now, because I also run an investment partnership that is invested strictly on an arm's length basis and a risk-return, risk-reward characteristics in businesses in Africa. What are the things that we see that differentiate successful entrepreneurs and business leaders in Africa from other parts of the world where we also do businesses? And I just thought of these as Jonathan was talking, so they're probably as good as the preparation that I've made on them. But my 10 characteristics would be something like this. First of all, the entrepreneurs and the businesses tend to be far less technically innovative, that there's much less technology innovation. And here I consider Africa to be, or our focus in Africa is north of South Africa. So we're talking about the 54 countries between North Africa and the northern borders of South Africa. Secondly, I would say that the entrepreneurs are far more involved and therefore necessarily more politically savvy than entrepreneurs in more developed countries. Now, some of that political agility I admire, and some of it I regret. The funny story I always recall is the minister of mining, a fictitious minister of mining in Nigeria who's got a big construction project and he decides to bid it, but can't give it to a local Nigerian entrepreneur. So he also invites a bid from a United States civil contracting company and from a Chinese firm. Chinese firm comes in and says, "Oh, we can do the job for you for $200 million. We'll get it done in 1 year, and we'll deliver a turnkey project." The American entrepreneur comes in and says, We can do the project for you for $400 million, but we'll get it done in 3 years. And the minister says, 3 years, why so long? He said, well, the first year we'll pass all the environmental tests, the labor laws, the international standards. The second year we'll assemble the team here and import the people to do it. And the third year we'll actually build it. And then the Nigerian contractor comes in and says, we can do the project as well. And it'll cost the government $300 million. The minister says, I'm very disappointed. Why would it be so expensive? He said, well, we can get it done in a year, but it's so expensive because it's $100 million for me, $100 million for you, and $100 million to hire the Chinese. So, thirdly, I would say that the difference in operating successfully as an entrepreneur in Africa is also an ability to deal with a huge informal sector. So just as Jonathan talked about Equity Bank in Kenya and their ability to organize and collect deposits from what was previously a big rural sector outside of the purview of the formal sector, that has been, similar things have been done in many other industries by people that are entrepreneurial successfully dealing with the informal sector. Fourth, I would say that leaders in Africa tend to be less strategic and more adaptive. Adaptive of technology developed elsewhere and adaptive of strategy, which is driven more by tactical opportunities at the moment than long-term strategic plans. I would say that entrepreneurs in Africa are also more tribal, so that you find groups in management and boards of directors and capital backers of businesses in the beginning that have very close affiliations with the entrepreneur because of family, tribal, cultural background that is a strong bond and an element of trust between them in the beginnings of a business. I think that entrepreneurs in Africa are also disabled by the ability to be Pan-African. It's very difficult to go from East Africa to West Africa. One of the entrepreneurs that Jonathan writes about is currently having great difficulty in establishing his advertising business, in successfully transferring it from a primary location in Kenya to a big operation in Nigeria. And there are many other instances of beer companies, retailers, banks that are difficulty in transferring their businesses and their know-how from one area where they're very successful to another area where the politics, culture, background of the people in the new area are different. I think that the entrepreneurs that are successful in Africa too, that we've either backed or observed, are more often from somewhere else than they are in other parts of the world. And by somewhere else, I mean somewhere else. I don't mean that they're always from India or they're always from China or England or the United States or the Solomon Islands. But you don't as often find a successful entrepreneur in Uganda who's Ugandan. He might be Kenyan, pretty close. If he's in Kenya, he might have received his capital and his backing and his initial entrepreneurial thrust from Egypt because of the similarity in the businesses that the Egyptians have developed. They also, a great deal of the entrepreneurs that have been successful that we've observed have been schooled somewhere else. At the educational facilities, whether it's an MBA program or a law program or an engineering program, many of these people are now returning to Africa, or did return to Africa many years ago, after a successful academic training somewhere else, somewhere other than Africa. And again, I would include South Africa as somewhere other than Africa. South Africans do also. I mean, I can't tell you how many times I've been in South Africa and met somebody for dinner in Johannesburg, and they said, I got to get home tonight because I'm leaving tomorrow. I said, where are you going? He said, it's Africa. So there is also in successful businesses in Africa a lot more vertical integration in the establishment of the companies than there is elsewhere. Even in situations where it's been pretty much proven that the model of complete vertical integration isn't the optimal model, right? I'd cite a meat production business or a chicken grower. There is no need in the developed world, or even in many parts of the BRIC countries, to own all of the chain of integration of production. You don't have to own the farm, grow the protein, whether it's wheat or another crop, actually grow the animals, slaughter them yourselves, and even distribute them yourselves. But much more often in Africa, that chain of vertical integration is a successful one and necessary because of the difficulty of depending on the outsourced activity. Obviously, there are many more successful entrepreneurs that are either successful around natural resource businesses or because of natural resources, much more so than in other parts of the world. And lastly, I would say there's also more of a kinship in the corporate governance of even large companies between family groups and the entrepreneur. So it isn't a coincidence that 4 out of 9 directors on a board would all have the same last name. And this is something that is changing. And as companies become publicly traded and as the equivalent of the SEC develops in all of the countries, good corporate governance is definitely something that has arrived. But still, there's a much greater concentration of affiliated parties on boards of directors, most of whom are supportive through thick and thin of the chief executive than exists in other parts of the world. So, with that, I'll stop talking with my observations. Jonathan, I don't know if you'd agree with this or disagree with it, or Antonio, but I'll give you a chance to comment. Or maybe have other observations about other things that are elements of success.
No, why don't we have a discussion rather than just going off in a different direction. So Paul said that he agreed with 98% of what's in the book. That rundown tells me that Paul's being a little generous. I think that I would say that based on that rundown, I heard about 50% agreement with what I have in the book. So maybe let me talk a little bit about areas, just point out areas where I agree or where Paul has made a point that I didn't make but is absolutely valid. And then just talk about maybe some of the areas where I see it. I don't know that I see it in the opposite way, but I see it a different way. Right? So I think a couple of his insights are really spot on and elaborate on things I mentioned only briefly in the book. One is that South Africa is different than the rest of Africa. Definitely something that came up again and again amongst African CEOs who were not in South Africa. I myself found that a lot of South Africans think of themselves as the entrepot and the leader of the natural leader of African growth, and that very few people outside of South Africa see it that way. But the notion that they're separate is quite clear. I did find actually that the integration of North Africa with sub-Saharan Africa is much more than most people anticipate, particularly along the west coast, sort of Morocco going south. And some of the experiences of Attijara Wafa Bank, the largest bank in North Africa, and its growth down south, Sept, the largest Algerian company, and its growth down south, reflect that. But these distinctions, I think, are not so apparent from way over here. The other that I would strongly agree with is the excellent point Paul made around vertical integration. This is sort of what I meant by they build what they need. You're right, that's true everywhere, only what you need to build is much more in Africa. So whether it's Vimal Shah, who built the largest agribusiness in East Africa and is deeply vertically integrated, even though his main business is edible oils, he goes all the way back to the plantation to get that done. or whether it's more of building out an ecosystem, as Funke Opeke, the CEO of broadband cable provider Main One, does in Nigeria. She understands her success is tied to building out the full ecosystem of data usage in Nigeria, including local content development, right? So that kind of expanding beyond your presupposed business model and the business model that would typically work here was I think really well articulated by Paul. So where do I see some differences? I see some differences. I'll just hit the points briefly, and then maybe we talk about them some more. But in Pan-Africanism, at least these CEOs that I spoke with, and they may be a self-selective group, have a very strong and powerful vision of at least regionalism, and then furthermore of African vision. Now, the execution of that vision can be challenging, and the CEO that to which Paul's referring is having great difficulty is someone who I know as well. That's true, but the fact that his firm has gone across the continent, as have most of the others in the book, not all, but most, speaks to me at least of their ambition. And several of the CEOs who came in from outside and chose, when they had the choice, to pursue one region or another, but instead chose a Pan-African vision. Smart guys like Tim Salso at Cummins or Sonny Verghese at Olam. Speaks to me of the wisdom of a Pan-African vision for companies operating there. At least whether that's executed from the start or pursued serially is another question. But to me, it has merit. And then finally, around being politically savvy. Well, this is a central issue, right? Listen, how I would perceive it is that the CEOs that I know operating in Africa have politics as an arrow in their quiver. None of them do not. But as I spoke to CEOs, particularly younger CEOs in Africa for the book, they were projecting a message that is important, but less the sole arbiter of success that it had been in their father's generation. And maybe that's the distinction. That may be one of the distinctions in how I'm perceiving the continent, as opposed to how Paul's perceiving it. That I may be projecting forward a bit more. I don't know, but Paul, I think, is projecting a reality that exists now. I happen to think these realities exist side by side. I don't think anything that Paul said doesn't exist in large amounts across the continent. But I think it exists side by side with some of the things that I've described. I would submit that the trend line is in the direction that I've said, but that's just my perception.
Let me just offer some views about some of the things that Paul said. First is about the growth polls in Africa. As the numbers will show soon, Nigeria will surpass South Africa as the biggest economy in Africa. And that's important because it will change completely the perception about the continent. And in your book, you had made reference about Lagos and how dynamic and lively the country. And that's a clear reflection of where the dynamism on the continent resides now. It's in Nigeria. I mean, it's really pulling all sorts of processes in the continent. I mean, you look, I don't know whether you profiled Dangote in your book, but this Dangote is the richest man in Africa. He's a billionaire that built his empire around the cement industry. I think this is a very typical example of somebody that went beyond the how do you call it, the normal practice, which is exploiting and opportunities and rentier behavior around oil, gas, gold, and so on. And he went to an industrial mineral, limestone, gypsum, and built things that matter for development, local development. So Dangote is the richest person in Africa. He's Nigerian, and Nigeria is setting the scene in terms of growth of the economy. One thing that I fully agree with you is about the importance of the informal sector. I mean, addressing market failures in the informal sector is the next challenge on the continent. Most of the economy is informal, and if Africa manages to address those problems, and then the growth rates on the continent will be much, much higher. Now, you made reference to technology innovation. Well, my comments there are how do you call it? There is a lot of technology innovation happening in the continent, as reflected, for example, by mobile banking, the M-Pesa case in Kenya, where through mobile phones, access to all sorts of payment systems were delivered to populations in informal sectors and so on and so forth. This is just one of many other examples of technology innovation. Now, on intra-African trade, I mean, this is something which the statistics have not yet captured it well. But there is a lot of, despite all the barriers of, and which you made reference to, that it's very difficult to move from, let's say, from Kenya to Nigeria. There's quite a lot happening. I mean, this is a lot linked with the ease of moving around now. I mean, companies like Ethiopian Airlines are playing a very important role in addressing some of those constraints, which in the past were really serious. I mean, you could not travel within the continent. So, and now the volume of intra-African trade, it's not documented, but it's important. And it is what is driven a lot of growth, for example, in the East African community. The transactions between Uganda, Tanzania, Kenya are much more important than their trade with the outside world. And I mean, another important dimension to notice what you've indicated there is the role of China and India. I mean, these global shifts are important in the way in the way Africa is resurging. A lot of it has to do also with this diversification of trading opportunities and competition in access to finance and so on and so forth. China, for example, applies things like resourceful infrastructure as a means to accessing resources, and through that model is addressing some of the infrastructure gaps on the continent, which is, as I said earlier, are important to making the continent competitive.
I know I'm, as the what was I described, the man of the hour, I'm supposed to be giving only answers, but actually I had questions for each of you. No, but it's more to explore an interesting point. So, well, first of all, I'd like to agree with Pedro that your point on the informal economy is very true, very distinct, and critical. That is a big one. So for Paul, you mentioned that you've noted that entrepreneurs that are successful that you've observed are often not from the place where you find them. And I found that very interesting. I'm curious if you have thoughts about why that is.
I think it's because a lot of the opportunities that spurred the growth in Africa were natural resource based, and that whether you like them or love them or hate them, the Chinese are very, very important in the last 10 years in the Renaissance in Africa. And a lot of the non-resource businesses wouldn't be able to exist if they weren't, if there wasn't plenty of oil and gas in Nigeria or copper in Zambia and so forth. So I think that the presence of a lot of primarily foreign capital in those exploitive industries have led over to citizens from those different countries coming and beginning other businesses. I also think that a lot of the innovation in Africa is adaptive rather than real technical innovation. Not to put too fine a point on it, but the M-Pesa technology used very cleverly by Equity Bank in Kenya is a technology that Equity Bank doesn't own, and Safaricom doesn't own, right? So Safaricom is 40% owned by Vodacom. Vodacom South Africa developed the technology for M-Pesa, and not the Kenyan, not subsidiary, but affiliate. So people have found ways of, their supermarkets are easy. They come from somewhere else. Somebody knows how to run a great supermarket business in India. They come and replicate that in East Africa. And the dearth of, to me, the primary, the scarcest resource in Africa is management and knowledge. And it's people from somewhere else, often because there was knowledge and training and experience elsewhere, and they brought it to Africa. But listen, Jonathan, I do agree with 98% of what you said. And I don't want to cast myself here as the guy who's the Cassandra here on Africa. I'm very much optimistic about Africa. I was trying to describe the game as I see it now, not to say that the game isn't changing in the same hopeful direction that you're seeing it.
So then I'll play the Cassandra. My question to Pedro. So you mentioned that intra-African trade is important and undocumented. So the best documentation I could find on this is that intra-African trade is miserably low. It is 11% of 11% of total trade. Do you think that that's? But I don't know if I trust that data. Do you think that data is inaccurate? Do you think that there is some hope that the data is not telling us?
Well, as I said earlier, the numbers don't capture the magnitude of transactions, and because first, very large percentage of it is informal, and capturing informal trade is difficult anywhere in the world.
Yes.
Yeah. So I mean, one of the major issues to be addressed in Africa in changing the narrative is really addressing the statistics. Yeah. We don't have statistics. I mean, reliable statistics almost on anything. So there are all sorts of initiatives out there to try and resolve that problem. If I may just change a little bit the discussion, it's about some of the constraints to success in Africa. I mean, lack of capital. This is a serious constraint. I mean, the costs of borrowing on the continent are the highest in the world. I mean, you are talking of some figures beyond, double digits, 13%, 20%, and so on. So if that issue is not resolved, it will be very, very difficult to harness all the potential that exists on the continent. There are all sorts of initiatives out there, like, for example, making sure that resources from the diaspora are better captured, and there are vehicles that are created with a view to channeling those resources to productive investment, because most of the resources now goes into consumption. My question to you is, what is it that you've seen there on the continent in Africa that would provide an avenue to addressing the lack of capital? And that's Paul also, since this is your area.
Let me, Jonathan, you be the arbiter. I'll take the opposite point of view. I don't think that the lack of capital on the continent is a problem at all. I think that, sure, capital is required for almost everything, especially for the development of infrastructure and agriculture. But there are sectors of these major sectors of economies that are over-capitalized and producing low rates of return on equity. Insurance is one. There's intense competition to open up new businesses in most of these countries. So why is capital, let's take the extreme. Capital is very expensive for Zimbabwe because Mugabe wants half of every business to be given to local people. In Tanzania, capital is short in certain industries because there are restrictions on percentages of shares that can be owned by non-Tanzanians, right? There are political reasons why Shell wants to close different facilities in Nigeria. It seems to me that the cost of capital and the access to capital is one of the easiest things for Africa to come to grips with by change of governmental policies.
I think I'm surrounded by my betters on this question. I for one I have to admit that I have been a bit mystified by how strongly both these cases have been made to me by entrepreneurs as well as by providers of capital. I guess the one other area that I wonder about, Paul, and you may have more insight than I or Pedro may, is the availability of the large stock of African capital that is in pension funds or other state-controlled entities to invest fully in the economy, which seems to be constrained, again, by policy. So to the extent, I see you nodding, to the extent that's true, that too is a policy and political solution.
Huge opportunity for Africa, especially in larger capital markets like Nigeria, where there's such competition for the relatively small stock of shares that are traded in public exchanges. And if the Nigerian pension plans are all further liberalized so that they can invest in these companies, the small number of companies are going to be bid up in price even more. So I think that the far-sighted policies in these countries would be to have tax and regulatory incentives for more and more companies to IPO and to provide accessible shares for both domestic and African and non-African capital sources to purchase. Right now they don't have them.
You seem to be advocating for, let's say, policy reforms, for more policy reforms on the continent, to open up more space, to liberalize more. That, of course, is important, but some of the forces behind the Zimbabwean cases, the Namibian cases, the local content agenda is driven by serious social tensions, where if those are not well addressed, if those expectations are not well managed, then the reforms will not be sustainable. So I'm perhaps suggesting that it's important to balance the need to create favorable business environment, but also being conscious of those processes. Failure to which, as I said, in our part of the world, in the extractive sector, we all like to talk about the social contract to operate. Your social contract to operate then get very jeopardized completely. So that's one of the major challenges in Africa today, especially in resource-rich countries, is how to manage these expectations. And some policymakers are using the local content provisions as a means to addressing some of that. And most of your book, Jonathan, is about the big guys, the CEOs and so on. But there's the missing middle there, or the middle missing, I don't know how you put it, that is important to also consider in this. And local content provisions are important in the sense that by creating or legislating for greater participation of local companies, for example, in the value chain, and addressing the problems that inhibit them to meet the standards that are required for you to be able to supply, for example, the large multinationals, is an important recipe to having inclusive economic growth. Because the numbers about Africa are, of course, are impressive. You have double-digit growth in a couple of countries, but it's important to interrogate the quality of that growth. And what I'm therefore suggesting is that through so the multi-pronged strategy where, of course, you are promoting foreign direct investment, you are trying to improve your overall business environment, but at the same time, you take care of your house, you manage your expectations, and create the necessary balance. I think that's important. I don't know what's your take on that.
My take on it is that it's a very interesting statement. No, really, it's pretty powerful. I'm conscious that we have a lot of people in the room where we want to open it up for questions.
I want to ask you one more. I want to ask you one more question.
Yeah.
And Antonio, I think that's very well said.
Yeah, I thought.
I
so
agree
too.
with it, and I didn't mean to suggest it's a simple problem.
Yeah.
Jonathan, in discussions of China in the book and of the United States, one of the things you didn't address was the Foreign Corrupt Practices Act governing American businesses doing business in Africa. Do you have an opinion of whether that's an inhibition to a significant, certainly some inhibition, significant inhibition to American businesses, and would you advocate a change in the law?
So I have an opinion on this, but I'm continuing to learn on it. Right?
Mm-hmm.
I think you've asked two questions that are important in your question. One is it an inhibition? Is it inhibiting U.S. companies from investing more in Africa? And then the second is it inhibiting, I take your question in two parts. Does it inhibit them from going, and does it inhibit them from winning once they've gone, once they've made the decision? And I think from my current perspective where I am today, the answer are yes and no. That is to say, yes, I think there are multiple companies in the U.S. that do not make the jump into Africa or other fast-growth markets because they're concerned they cannot operate there in compliance with FCPA, or maybe even compliance with their own values, right, which hopefully are fairly well aligned with FCPA. So I think it does keep Americans from making the jump. My perspective is that the FCPA does not put American companies at a competitive disadvantage once they're there. That's a much contested view. There are many executives who would say it does. But as you'll see in the book, there are the CEOs who, at least I spoke about with the book on this topic, and I asked them all about corruption, said, ultimately corruption is at best an uncertainty, because you don't know how, once you're getting in that realm, you don't know how you're going to control it, and you don't know its costs. And at worst, it's a tax that you're going to wind up paying more and undermining the profit of your business by pursuing it than if you took a hard line and did not pursue it. That's sort of the Mo Ibrahim. That's how Mo Ibrahim laid it out. Listen, basically, this is a tax. And I would say that Tom Gibeon really opened me up to the notion that whether it costs more or not, it's just too uncertain for him to roll the dice on. I would say that between those two basic ideas represented by those two individuals, I find and the number of successes I see of companies that I think are adhering to FCPA in the whole, I'm somewhat convinced that it does not inhibit it.
Okay, well, we have some time for some questions. Other people in the audience, would you identify yourself? And if you want this to be answered by any one person, directed to them. Yes, ma'am.
Press the speak button.
Just let me say just before your question that also your question really was you also asked would I advocate changes in the law. I have to admit on this score I'm not familiar enough with each aspect, with each element of the law, and there may well be some aspects that merit reform.
Yeah, it's hard to come out in favor of corruption. I've tried it, but it's never worked. But there are some things like criminal liability for a director of a company, even if a subsidiary takes it. There are things in which the law could be modified. Okay.
Right. So I'm open to those.
Yes,
My name is Jacqueline Spann. I'm the president and founder of Education and Literacy Fund for Africa. what we do is build schools from K through 12 that specialize in science, mathematics, engineering, and technology for the poorest of poor in South Africa. Now, I have been, as an American, I have been going back and forth to Africa for over 9 years. And I am just really surprised at the number of countries that have descended on the continent like locusts. I don't even know how Africans can keep up with it. And in addition to that, it seems to me like the richer the resources, the poorer the people are. I mean, where is the money going is my question. And now you've got China there, and China is very aggressive. I mean, all of the countries really are aggressive. Some are sneakier than others, but they all are aggressive. And I feel like many of the leaders are overwhelmed because, for example, you mentioned Nigeria. There's so many people flying in and out of Nigeria, you know, that keeps the people who can do business occupied. So what is going, I mean, you know, how do you help the people on the ground? How do you improve your country individually if you're overwhelmed with all of these other countries and interests daily in Africa? Please answer that question.
I couldn't begin to. What is the question?
The question is, as I said, that if you were talking about how the leaders need to have different ways of doing business. I'm saying how, if you have all of these nations descending on your country, and they are constantly, you know, they're competing with each other, and there is corruption, and there's all kinds of things, and then you have the people that are poor, the numbers are getting bigger and bigger. You know,
would you accept a friendly amendment to ask Antonio Pedro in the country where he lives is Rwanda, and President Kagame regularly meets with foreign interests and tries to establish himself as a commercial hub in East Africa? How does he do it and treat the people fairly?
Well, it's right that you have China-Africa Summit, you have Turkey-Africa Summit, you have Brazil-Africa Summit, you name it. And for many years, the continent did not have its own strategy to deal with all of those countries. You would, I mean, for example, there's this caricature of, the China-Africa Summit, where you had, in those days, who was the president in China, was the former president, and you had all of those 54 African heads of state going there shaking hands to the president of China. But now it is changing. That's why I made reference to Vision 2063. And going back to your question, Paul, for example, President Kagame knows exactly what he wants. And it is captured in all sorts of instruments, like, for example, the Vision 2020. They have instruments like Economic Development and Poverty Reduction document, EDPRS2, which is about transforming Rwanda into a middle-income country by 2020. So, in his dealings with all of those countries, he knows exactly what to ask each of those countries. So it's important. What I'm suggesting is important for anybody to have a vision, to know what to expect, to develop a profile about the countries, have a sort of intelligence about what is it that motivates their interventions. And you made reference to China coming and scrambling for Africa's natural resources, which is part of the narrative. But what is now being understood is that if you know what to ask to China, China will do what you are asking for. For example, if you compare the resourceful infrastructure deals between China and Congo, DRC Congo, China and Angola, and China and South Africa, you'll see that there is a difference there. The first one is poorly negotiated. Well, if there's anybody from DRC, sorry. If it's a poorly negotiated deal, where almost everything is made in China, there is no local content. If you move to Angola, I mean, the degree of sophistication of the deal is much better. There's a little bit of more, I mean, made in Angola component in the deals. And if you go to South Africa, it's even much better. So it's what I'm arguing for is that there's nothing wrong with China, with India, Turkey, and so on. It is Africans that have to take care of their own business, get prepared, and negotiate better, strengthening its bargaining power, and so on. So, I mean, it's not an issue of, well, I'm not suggesting that you are blaming China and India. What I'm arguing is that it's really up to Africa to raise its game and understand the changing world, the opportunities that it offers, and equip itself accordingly to harness the best out of it. So that's what I would
And help the poor.
Sorry?
And help the poor. That's an outcome.
Yeah, absolutely. Yeah.
Another question?
My name is Gina. I'm an MBA student here at Columbia. I'm also a South African. So the question to me, to 2 points. One, Paul, to your question, your statement around South Africans seeing Africa as not part, South Africa not part of Africa. I think that's a view that's something that's of the past, and the changing viewpoint much more so today is of South Africa as an entry point into Africa, and very much so that we've got to harness ourselves to Africa, otherwise we're never going to succeed. But further to your point around Pan-Africanism, you see so many of the leading South African companies expanding into Africa very aggressively. And so the question then is, to what extent do you think that that's possible? South Africa is going to be able to maintain and defend its position as the leading country in Africa and as the leader of the continent through its efforts of its major corporates, so the likes of ShopRite and MTN, as they expand up?
Pretty tough to predict, but because of some of the things that were said about the size, power, resources of Nigeria, I would think that over time, the Nigeria and Egypt, pending resolution of their current changes, and Kenya, and to a lesser extent Ghana, will take over leadership of the continent from South Africa. But still today, South Africa is an awfully powerful engine from the standpoint of developed infrastructure, technology, and educational base. So I don't think that all disappears quickly.
Yeah, so does it work?
I'm sorry, I can't hear you.
Hello? Right.
What he says.
So, also a question, Paul. First of all, I wanted to, now that we're here in a country that still pays its supermarkets with checks and everything, I think it's a bit unfair to say that Safaricom was not innovation and Facebook was not innovation on Safaricom's part, because obviously it was more process innovation than the quite simple software package innovation. But my question was that if you're saying that this is all on the back of commodities and everything, so I mean, oil has been around in Nigeria for a long time, copper has been around for a long time, and whatever the Congo has, I can never remember the names of these things, but it's been around for a long time. So what has changed now?
Well, first of all, I certainly don't think that Safaricom isn't an innovative and fantastic company. It's one of the companies that is the highest position in our portfolio. But I'm saying the original technology was not in Kenya, and that the genius of the company is the adaptation of things that they found elsewhere. Secondly, what's changed in Africa as far as, well, I think as resources have developed wealth in different economies, that has created more and more revenue for a growing middle class, and that growing middle class is consuming everything from television sets to packaged goods, combs, consumer products, and so that there's a flood of innovation and new businesses. But if in some of the countries that depend primarily on some commodities, there were a big change in the demand or the price of those commodities, you'd feel the repercussions in the affiliated, not affiliated, but in the industries that are now serving the middle class, because there'll be more unemployment and less income. I cited Zambia as an example, but if the price of oil and gas, if the price of oil drops, it's not going to go unnoticed in Nigeria.
But sorry, just to add a little bit, the story of growth in Africa is not only a story it's a resource-driven growth. You can pick Ethiopia, it's been growing at 8%, 11%, and it's not yet a resource-rich country. There, growth is driven by infrastructure spending. It's driven by consumer spending and so on and so forth. So it's of course you have countries like Equatorial Guinea and Angola and so on, which are growing because of oil and gas and so on and so forth. But it's a mixed story. There are other drivers, as I mentioned earlier. The growth of the middle class, expanding liquidity on the continent is also driving growth. So it is. Sorry.
So this is probably a good point at which to mention that Africa is not one place.
Yeah.
There's 54 or maybe 55 countries, depending on who's counting, and with very different resource bases and growth stories. So for me, both of the things that Paul and Pedro have said are true. I find myself wondering how they play out when they come together. So Kenya is a country that has had sound policies, right, investment in infrastructure and its people, and has been yielding a pretty good growth story to date. And beginning in 2016, they will start pumping oil, a lot of oil. It's actually not quite known how much yet, but it's a very significant commercial find. How that will play out in an economy that is already doing well, how it will support or distort the economy and the political economy is something that I watch very closely and for which I don't have a clear answer.
Yes, sir.
My name is Carl Donko. I'm a student here at Columbia, undergraduate, and my question pertains to, it's going to be more so Mr. Tierney, but I think this sort of applies to everyone after what Mr. Pedro said about economic infrastructural investments in Ethiopia, is that how does the private sector able to compete in some economies where there is economic rent-seeking by the government, like in Ethiopia, Rwanda, Angola, where the choices industries are controlled by the government, like the national airline, the banks, the power system, the telecom, and so forth, and all of the profit and revenue is taken by the government and then subsequently taken into infrastructural projects as opposed to, say, being put out in the general market. How do our companies not only compete with the government, but able to exist within that framework altogether due to the restriction of capital and the restriction of liquidity in the system? Are these sorts of countries fated to fall behind more liberal economies like Ghana, Kenya, Nigeria, or is there a way forward for them, for enterprise and private sector growth in these sorts of countries? It's obviously to them.
Well, if you're asking the question as a policy issue, I'd say yes, they are likely to fall behind. If you're asking a question on a practical basis of how is it possible to participate in industries which are controlled by the government today, there are ways, right? Ethiopia, it is possible for an airline, for example, to be a code share partner with Ethiopian Airways.
Well, I think there's if I remember correctly, there's actually a law in Ethiopia that prohibits any private airline from owning more than 10 planes.
I'm not suggesting that there isn't such a law, but their ownership is a very sophisticated concept. there are leases, there are management agreement, there are subcontracts, there's revenue sharing on code shares. And the same thing is possible in some other industries, but it isn't easy, and a lot of people would just throw up their hands and say it's not worth it. So if a country opens their arms and wants people in and has a fair tax system in the eyes of foreign investors, they go. If it's tough to do business, and currently it isn't as easy in Ethiopia, they avoid it.
So absent from Paul's brief bio is that he served on the board of a major American airline. So he's, when you're getting a little bit of an inside play on how that's done.
I wanted to just say, I wanted to say that there is no fixed recipe for growth. I mean, if you look at, for example, the growth trajectory of Southeast Asian countries, the Malaysians, Korea, South Korea, and so on and so forth, you will see that, I mean, it's a mixed sort of set of policies that, to a certain extent, it included also what you call rent seeking. I'm not suggesting that that's what would be best for Africa. What I'm asking you to do is to open yourself to more flexible understanding of what makes a country grow. And I mean, context matters, the social dynamics and so on and so forth, the political economy of growth is important. So there's, the message to retain is that there is no fixed recipe to growth.
So I just want to comment a little bit. It was a terrific and nuanced question, as evidenced by the quality of the answers it elicited. Hopefully not to draw down the quality some. Just a word on the landscape that you described. So to me, there's actually competition at two different levels there. One is between the state and state capture of profits and commanding heights of the economy and competing with the private sector. And then the other is rent-seeking in the private sector, which I think has been the predominant model of large corporations and large domestic corporations in Africa to date. That is to say, companies or businesses that had a particularly close relationship with the state had the predominant role in the private sector of the economy and squeezed out others. And I find that those companies are competing with a newer class of large African companies that are essentially productive, competitive enterprises. Often they're the ones that are jumping national bounds. And it's not that those companies don't have political ties. A company like MTN surely does, but that it is not the focus of their competitive advantage. And they do sort of, and I think they are sort of in a struggle of sorts with the companies that are often single country in nature, highly politicized and rent-seeking. Why don't I pause there? Just I see the landscape in these two sort of significant struggles.
Yes.
Hi, I'm an LLM student here, originally from China, but my question concerns not so much about like Chinese commodities in Africa, but more about the infrastructure and oil and gas project in Africa, because I work in Paris in a law firm mostly on this kind of project, and I want to know your opinion on the market. Like, do you think it's a striving market, that there are going to be a more and more this kind of project in Africa, or is there any constraint? Your point of view.
And which market was it? Can you just repeat? It was infrastructure for resources or independent?
Yeah, for resources or transportation in general.
Listen, the demand for infrastructure is fantastic, right? Across the continent. That seems to be not the constraint. The constraint is the capital. And here I do think it does seem like it's a capital constrained environment. I think the estimate is that $93 billion per annum is needed over the next 10 years to meet the needs, however those are defined, the needs of the continent across water, power, road, and road, rail, and port. There is an effort, probably the most significant effort underway to date, has been launched by the African Development Bank called the Africa 50. Yeah, to raise the fund, public and private, to invest in it. I don't have enough foresight to cast a vision on the prospects of that initiative. The infrastructure investors that I speak with are not none, but not all, but a few of the largest, have a lot of appetite for it, but in a very small number of countries. What I see today would leave most of the continent out. So I see big holes. I don't know how they get filled, but the constraint is the capital.
Just to complement what Jonathan said, indeed, infrastructure is a major challenge, or the quality of infrastructure in Africa is a major challenge. And to the extent that there is an initiative, which is called the Program for Infrastructure Development in Africa, PIDA, which is being designed with a view to addressing that problem. And earlier I did mention the African development goals. Part of the goals will be about infrastructure, how to make sure that Africa has reliable, efficient infrastructure. Now, so the market is growing. There is, as you said, requirements are in the billions per year, and all sorts of models are being considered to try and expand the availability of resources to fund that infrastructure. There are ideas on, of course, optimizing the infrastructure for resource for infrastructure deals, looking at the current models and see how they can be improved by increasing competition around it, because currently it's captured, as you know. There's no proper procurement and so on and so forth. So that's what I think the continent is looking at, and there are a couple of concepts that are being championed, like, for example, the resource corridors, which is based on the understanding that especially the extractive sector provides necessary rents to support this trunk infrastructure. The idea is to see how the trunk infrastructure can be used as a basis to open up other sectors of the economy, including agriculture, tourism, and so on. So those are the ideas that are being discussed on the continent.
My answer to that question would be that the market is huge. And I don't know if you would include this as a part of what you'd consider infrastructure, but today, Dangote announced in Nigeria plans to build a refinery, a huge refinery, with a capacity of 400,000 barrels a day. Now, that's the sort of project that not everybody can walk into Nigeria and do. But with the permissions of the Nigerian government to do that, he'll find a lot of ways to mobilize the capital to build that infrastructure. Yes, sir.
Thank you. I'm Rob Colorino. I'm with an investment. We have a couple of investments, manufacturing investments in Africa. My question is if you touched upon about an entrepreneurship of what might be unique within the African space that works. And sort of related to that is you're seeing things like in South Africa, the Companies Act and restructurings and basically the opportunity for turnarounds and see more protection. If you have any flavor to add on that.
Well, I don't know. So Paul ran down, I thought, a pretty interesting 10-point list of what distinguishes African, what suits the African market, success of African entrepreneurs from others. certainly the ones which found agreement across the panel were included in, help me out if I don't forget some, but pardon me, an ability to interact, and I'll characterize, an ability to interact effectively with the informal sector, which of course is far larger in Africa than certainly than in mature markets and in most other markets, period. The necessity for, a capacity for vertical integration, even in sectors where vertical integration has been dismissed as a model in mature markets, in fast growth markets like Africa, it's often makes sense. And Paul has brought me around to technical adaptation as opposed to innovation, just as we've spoken about it over the course of the hour. The ability to adapt.
I was just changing my mind on that.
Oh, you were? Well, somewhere in the middle there, there's on adapting technologies that exist elsewhere to the fast growth market. Were there any others of the highlights that you wanted to bring out?
No, I think a lot of what we've all agreed on, though, is that the African entrepreneur, the ones that have been successful, are tremendously resourceful, right? They deal with a million things.
Yeah,
you find a guy in the United States starts a business in the tech area, he's got an idea, and he drives it and drives it and drives it, and he doesn't even know where Iraq is. You know, very single-minded and very strategic.
Yeah.
I think in Africa, by the very hugely talented, multifaceted people, able to adapt and innovate and use and be knowledgeable about many, many subjects that go beyond the narrowly defined mission of their organization.
You know, I'll say one more that I think is part of what you were saying, which is a capacity for operational focus in terms of the leadership of the company. So, you know, I don't think there's a place in the world where it doesn't matter that the CEO knows how the company works and has his hands and has his sleeves rolled up, or her sleeves rolled up and in the business. But I have observed that in Africa, even a very large firm, I've been interested and surprised by the degree to which the CEO is engaged in the operational execution of the business, sometimes at the expense of either strategy or finance. So, for example, James Mawario, who runs the largest investment company in East Africa called Sept, publicly listed investment company, said, you know, when we look for a CEO to invest in, it's not the guy who's good with investors. It's not someone who you can take to the city of London. That's probably the wrong guy. The guy we're looking for, or woman we're looking for, is someone who can essentially serve the COO, what would be the COO function here, because. You know, and I suspect it's because operations are so difficult in a fast growth, underdeveloped market, and they're so consistently challenged, requiring leadership that has to come from the CEO. That's my supposition, but the fact that they've got to have that sort of operational focus seems to be universal.
Yes, ma'am.
Sharon, I work with Chazen, and we live in a very global world. People and multinational companies can invest in a lot of easier places than Africa, and often get pretty good returns. What can African companies and governments do to convince them to put the money there and their efforts in Africa as opposed to some of these easier places not go into?
Well, as I said, I'm not an investor, but let me offer something that is important. I mean, books. It's important that you hear this. But I said books like these are very important to change the perceptions about Africa, because perceptions matter. Perceptions dictate how you behave, including your investment decisions. So that's important. So changing the narrative about the continent. I guess and also saying that there's quite a lot of things that are happening on the continent, as was clearly illustrated today. I think the continent is getting the basics right. I mean, as indicated earlier, the macroeconomic fundamentals that are in many countries being properly addressed, to the extent that it's easier to, for example, it was easier for Zambia, Rwanda, and I guess Ghana to go to the market and borrow money than it was the case of Spain, for example. So, yeah, there are people, of course, that are against that practice. There was a quite interesting piece on that. But anyway, so getting the basics right is important. Telling the Africa story better and let it be known by the potential investors. And then there is also something that I like to make reference to is what I call the joint responsibility. In the sense that, and that talks to the issue that I think was Paul who raised it earlier, about some measures that are taken in home countries, like here, like the Foreign Corruption Act, and so on. This is important in the sense that it also helps increasing the domestic accountability and governance in our respective countries by forcing companies to behave better, and through that process also improving governance standards in the host countries. So I think this notion of the joint responsibility of shareholders and how they, where they invest in responsible companies would contribute to making Africa a much better destination. That's an investment destination.
I'm sorry, but we're running out of time, so I'm going to suggest that we terminate the official part of the meeting. The panelists will stick around, and any questions you want to have, come on up. Thank you very much to